Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, January 16, 2018. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we had an interesting day today. We had what's called a gap and crap. We've discussed this many times. That's when the market gaps higher in the morning and then reverses and finishes either on or near the lows of the day. That's pretty much what we had today. Can this be classified as a reversal day? Not quite yet. It's the makings of a reversal. However, there's really been no damage done to the chart, and this isn't necessarily a bona fide reversal day. If it were to be a reversal day, I would have liked to see the day finish below Friday's low. That's not what we had. In fact, we found support in and around Friday's low today, and the market bounced off that level and limped into the closing bell. One thing we want to keep in mind is this week happens to be options expiration week. And as we know, during options expiration week, a lot of things can happen. The market goes up, the market goes down. We have a lot of whipsaw days in terms of options expiration week. So we have to be careful because it's really the job of the options desks at the large institutional trading firms, the institutional banks. This is the week where these traders that are on these options desks make the majority of their money during this week, during options expiration week. So, with that being said, we have to be careful for the market getting whipped around during this week. And it also is the perfect recipe for that to take place because we're going to have a lot of stocks reporting, or a lot of companies, I should say, reporting their quarterly earnings from fourth quarter beginning over the next couple of days, and then it's really going to pick up into next week. But we're going to have enough to where the folks on the options desks are going to have reason to whip the market around. When we take a look over at the 10-minute chart, we can see what happened during the day, during the trading session. You see where the market gapped higher at the open, and then after the third candle of the day, the third 10-minute candle of the day, the market rolled over, put in a bearish pattern for a while, and then collapsed one more time. The market found support in and around this gap here. So you have a gap window right in here, and then you have a gap fill down here, and the market actually found support in between those two areas. Had the market come into this 200-period moving average, here's where the trade really would have taken place. This would have been a great trade down here, just slightly lower than I just drew this line, but that's where the actual trade would have taken place that I was willing to take. Not that a gap fill area isn't supportive of the market, but what you can see here, and this is the reason why I was eyeballing this level, all this consolidation in here, and keep in mind this is a 10-minute chart, all this consolidation in here to me would have been supportive of the market. We came up just short, and therefore the market had a bounce ahead of time. And then into the closing bell, you can see what happened. We had a nice big up candle. The market started to make a bullish consolidation pattern, but then failed into the closing bell. That does not bode well for tomorrow. But again, options expiration week, expect the unexpected. Anything can happen. However, as we go back to the daily chart for a minute, what I want to point out is, look how overbought this market is. Look how extended we are from home base. The 20-period moving average is home base. And as of this morning, before the market rolled over, we were really extended from the 20-period moving average. And I've been talking about this quite a bit of late, that the market, while it can keep going higher and away from the 20-period moving average, it's just unlikely, and that the market is going to have to at least do one of two things: come back toward home base or go sideways and let the 20-period moving average come up toward price. And that would be the market eating time off the clock, letting the 20-period moving average rise up in or near price. Now, from high to low today, the SPDR pierced through $280 a share. The low came in at $276.16 or $276.18. We'll just round it and say 276. And that's a 40-point swing in the S&P 500. That's 40 handles in the S&P cash index from high to low today. That's a pretty good down day for the markets, finishing the day about 30 handles off the high, or the equivalent of 3 SPY points. Now, when you look at the finish of the day, the S&P 500 really wasn't down all that much. It was down about 10 points, or about 1/3 of 1%. Now let's go over to the IWM, which, as you know, is my favorite leading indicator of the market. Almost a 1% down day, or $1.50 on the IWM. The IWM, or the Russell 2000 index, was leading the market lower. This was the index that had the most downside activity or downside pressure in the market today. So we did have a reversal day in the IWM. We had a nice pair of up days in the IWM last week, and today we took out the majority of that up move. However, when you look at the daily chart, and then of course the weekly chart, there's no damage done in any of these indexes whatsoever. So I just want to make sure that we're all aware of the bigger picture. It's just a down day for now. It doesn't mean we're going to get another series of down days. It doesn't mean we will or we won't. Right now, it's just a down day in the market. We need more information. We need more evidence if there's going to be more selling pressure in this market. But in terms of the IWM, it was a reversal day, but we have to see if we get follow through to the downside. If we get another down day tomorrow in any of these markets or all of these markets, and we close the day below today's low, that has a lot of meaning. Until and unless something like that happens, it's just a down day in the market. And keep in mind, in terms of the S&P 500, I think this is the first down day that we've had in 2018. So at this point in time, I'm not sure that we can make much more out of it than a down day in the market just yet. When we look over at the transports, the Dow Jones Transportation Average, this was extremely extended away from home base or the 20-period moving average. And today we had a whopper of a down day. It was down a lot more earlier than it finished. However, still down about 1.25%, 146 points. This is just working off some of the overbought, and I'll probably say severely overbought, condition in the Dow Jones Transportation Average. So are there going to be more down days coming in the transports? Likely story is yes. Whether or not it's tomorrow remains to be seen. Same thing applies. If we get another down day tomorrow and we close below today's lows, that has more meaning than just a down day in the market. So we need more evidence. We need to see follow through in order to say that the market has experienced, for example, a short-term top in this market. It's too early to tell just yet whether that has occurred. We'll also take a look at the VIX because at least a couple of times last week we talked about the VIX. I pointed out that the VIX was up while the market was up, which is a little bit odd to say the least, and it was the market's way of telling us something is coming. Well, here was the something that came was today, which was a down day in the market, and that you saw a pretty decent spike up in the VIX, finishing up 15%, but as you can see, we were up more earlier in the day. There's always something in the market that is the tip-off or the tell of what's coming. The question is, as an analyst, am I able to find that something? Am I able to read it correctly and interpret what the market is trying to tell us correctly? We talked about it last week that the VIX was acting strange, and that was likely a signal of something to come, and there it was. Today was that signal, or at least the beginning, or at least the culmination of that signal, one way or the other. The VIX spiked up, the market had a nice down day, and the VIX actually finished well above all its moving averages on the daily chart. So we'll see if we get any follow through in the VIX tomorrow, or are we going to get a collapse back down in volatility tomorrow or throughout the remainder of this week? That'll tell us a lot of information of what's to come over the coming days at minimum. Just to beat a dead horse a little bit, and I don't mean to do this, but I'm going to do this, each and every time the VIX gets below 10, and especially when it gets down in the 9 neighborhood, it's generally a buying opportunity, whether you want to buy call options on the VIX or you want to trade any of those leveraged exchange-traded products. Long the VIX down in that area is generally a good trade as long as you give yourself enough time. Usually, you'll get paid on that trade. I've only said this a few dozen times, but the reason I keep saying it is that the VIX never stays down there for very long. Therefore, the trade continues to work, and as long as it continues to work, I'll continue pounding the table on that trade. Switching over to the gold market, you can see here that we reached our target of 1338 to 1340. The other day, the gold market made a high of 1345, just a little bit more than I was anticipating on the upside. 1345 was the high on the 15th. And right now we're hovering just above that 1338 level. If the gold market decides to go sideways, that's going to be the market's way of telling us that it's building energy for another move higher. That next move higher, if it should take place, will want to fill the gap up at 1355.70. I think it's a little overextended right now. Could we run right up there? Of course we could. However, I think that if we're going to go up that high, I think the gold market would need to consolidate sideways for a few days, work off some of the overbought condition, build some energy, and then it's free to move higher. So for the most part, the gold market did exactly what we were talking about. It ran up here, consolidated for a few days, built some energy, made the next or secondary move higher, 1338 and beyond, and here we are waiting for this market to give us an indication of what the next likely move is. Right now, you can't be long gold here. You don't want to be short gold. So we'll just wait for the market to give us an indication of what its next intentions are. Crude oil has been on a pretty incredible run of late. You can see we're very extended away from home base or the 20-period moving average. A little bit of a down day today. We're down 40 cents on the day. Not a big deal one way or the other. This is still in a very strong uptrend. There's no indication that this uptrend is over right now. It's just potentially going to go sideways for a while or even pull back a little bit back toward the moving averages. But this is in a very strong uptrend, and I still think there are higher prices coming, not necessarily tomorrow, but higher prices, at least the way I'm reading the crude oil market, are in the cards. This market can get up to $69 a barrel, and then ultimately, and I'll bring up the weekly chart and I'll show you what I've worked out, is ultimately $73.78 a barrel based on this February contract is where I can see this market going. It's not going to happen all at once. It's not going to happen overnight, but I can see the crude oil market getting up to 73, 78. However, even on the weekly chart, look how extended we are from the moving averages, especially the 20-period moving average. So this could take a while. We could go sideways for a few to even several weeks before building enough energy to make another move higher. Now, before we wrap up this video, I want to take a look at some of the market-leading stocks out here. We'll look at the FANG stocks, we'll look at Apple, which is a market leader, and I want to see, and I want to show you that there's really no damage done to the market leaders on a day like today. So when money's coming off the table of the market-leading stocks, that's an area where we have to watch out for. That's an indication that there's a lot more downside coming in the market when a lot of money comes off the table in the market-leading stocks. So let's take a look at what we have in Apple. Down 86 cents. Not a big deal. Certainly we were higher. We finished on the lows of the day. But you can see here on the daily chart, there's no damage done. We're at highs for the most part. We're above all the moving averages. It's a down day of 86 cents in Apple. You can't make a lot out of that. When you look at a stock like Google, we'll look at Google L. Google L was up 47 cents today. Again, it looks like it wanted to make a reversal today, but yet again, even though we're extended from the 20-period moving average, there's no damage done on the daily chart. There's not a lot of money that came off the table in Google. It may happen over the next few days, the next couple of weeks. That's certainly possible, but just focusing on today, there's no damage done. It's just a day that we gapped higher, closed near the lows, but we still finished up 47 cents. So there really wasn't any money coming off the table in Google today. How about if we look at Netflix? When you look at Netflix, Same deal with Netflix. It looks like the same chart. We're extended from the 20, therefore it stands to reason that we have to work off some of the overbought condition, but there was no significant money coming off the table in Netflix today. A lot of volume today against the average daily volume. We had about 13 million shares traded in Netflix today, so it could be the makings of something, but you can't really say that there's been any damage done on the chart, and that's what I wanted to focus on. Amazon looks more of the same. Definitely good volume as Amazon. Definitely a gap higher and a crap out. But yet again, we still finished up on the day, so you can't really hang your hat on any damage being done to any of these charts whatsoever. However, that could change over the coming days. But for today, it was just a gap and crap, but there was no damage done. We are extended on the daily chart, on all these charts away from home base or the 20-period moving average. So I'm watching closely what happens over the next several sessions, not only to the major markets, but also to these stocks and a lot of others. And with that, it's everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.